Housing prices surge in Sydney and Melbourne. Let's have a look. Hello everyone, I'm Florian Heise and welcome to another episode of Heise Says. I have my stein of coffee here and I thought we'd look at this article because house prices are up in Melbourne and Sydney, guys. It's on. The boom has returned. All my concerns about the economy and everything, that can just go out the window. Just being a negative Nancy. You know, a downer. The boom is back. Quick, get in now. Get in. Now, for those of you that may not realize what sarcasm is, yeah, I'm not entirely confident. I'm going to take a shot of my Steiner coffee. It's good. So, house price surge in Sydney and Melbourne drags the national index higher. What does that tell you about those two markets? Those two sectors, well, it's not surprising, but can pull the whole, property prices for the entire nation up. So, very strong home price gains in Sydney and Melbourne last month are driving national average dwelling values higher. Didn't do it to my house, but analysts caution August's sharp bump is not necessarily the beginning of a fresh boom. That's good. That is good that they're cautioning people. I mean, if you got to sell, and you can get a bit more for it, good luck to you. Good luck to you, CoreLogic's monthly home value index showed a 0.8% rise in dwelling values nationally, while Sydney's gain was twice the size. Wow. Melbourne's 1.4% monthly increase also powered the overall result, while Australia's two biggest housing markets also had the biggest quarterly increases, just below 2%. No other capitals came close, with Canberra 0.8, Hobart 0.5, Brisbane 0.2. In other cities, the other cities posted gains, while Darwin was down 1.2, Perth 0.5, and Adelaide 0.2. Regional markets outside the capitals also lagged, with prices falling an average of 0.1%. So here you go. You can see their data. And let's just jump over to the... hang on. It's too early in the morning, not organized well enough yet. We'll jump over here to the live website, and we'll have a look at monthly, quarterly. Brisbane's down, Adelaide down, Perth down. Annual. Hobart's kicking ass annually. Go Hobart. There you go. It's all those great farm properties and acreages. Since the peak, everything's down. This is the one that you've got to keep an eye on, okay? Since the peak, Darwin's down 30%. We'll just leave it there and jump back to the article. So, step change upwards. Property prices had risen modestly for the previous 2 months of winter in Sydney and Melbourne, but CoreLogic's head of research, Tim Lawless, said the August result was at another level. The August figures really have taken a step towards change, which is a much stronger rate of growth than what we've expected, he told ABC News. Okay. What's driving this change? What's driving this change? Is it just fear of missing out in Sydney and Melbourne? Is that what it is? Because of the exceptional high prices, and we're sitting on a, since peak, a 13% drop in Sydney. Is that what's driving people? Are they getting in? But what else is driving it? Is there extra population demand all of a sudden in Sydney and Melbourne? Is there extra work there? Any big projects happening? What could it be? So that's... I mean, I'm thinking about this too much, aren't I? That's my problem. I'm too cynical. So, it does look like a growth trajectory is very much on the cards. Is it? Yeah, I guess. I mean, I've been doing trading and playing, and you just watch it and you think, yeah, it's going up and it's going down. It's a market. However, Mr. Lawless said the rate of price growth over coming months would depend on any policy responses from the Reserve Bank, the bank regulator APRA, if they become concerned that household debt begins increasing again from record levels. Mr. Lawless said the two biggest cities will be most vulnerable to any renewed mortgage lending crackdown, given that the ratio of house prices to house income are still around 8.5 in Sydney and 7.5 in Melbourne. I mean, that that is the issue right there, guys. That a house is 8.5x your household income in Sydney, 7.5x your household income in Melbourne. And it has to be measured on household income, because that's how people buy these things traditionally, as a household. I mean, that is just insane. That is insane. So just don't eat or do anything for 7.5 years and you paid off your house. I have to patent that. That's a new strategy for Melburnians to pay off your house. Just do nothing. Do nothing. Affordability constraints will probably continue to worsen from here if we do see housing prices continue to rise, particularly against a backdrop of very soft wages growth, he said. Particularly if we do start to see lenders becoming more focused on factors such as minimizing exposure to high debt-to-income ratios, you'd have to expect there would be impact on the very expensive markets like Sydney and Melbourne, more so than the more affordable markets. Pardon me. Yes, that's a good point Mr. Lawless makes there. I mean, but didn't we just had the Royal Commission into Banking, where they were addressing a lot of these things, and then all that tighter lending requirements, that all seems to have disappeared, doesn't it? It all seems to have gone out the window when they want to pour more petrol on the property boom fire. And I'm going to bring up this quote just to remind everyone to read Matt Berry's piece, which was really Australia built on a house of cards, looking at that property market. In 2016, 67% of Australia's GDP growth came from the cities of Sydney and Melbourne, where both state and federal governments have done everything they can to fuel a runaway housing market. The small area from the Sydney CBD to Macquarie Park is in the middle of an apartment building frenzy, alone contributing 24% to the entire GDP growth for 2016, according to SGS, Economics and Planning. So, guys, if you have not read Matt Berry's post, and I will, hang on, cards, I mean, here we go. He's got a Medium one as well. I don't know, I'm not that big on Medium, guys, but here you go. This is what it looks like, and I'll link to it if you want to go through it. It was one of the longest LinkedIn articles there was, apparently, and it's old, 64-minute read. I should just do a read through it for everyone, but it's a good piece to show you what's going on, and he knows what he's doing. I mean, he's one of the founders of Freelancer, so he's not a two-bit guy that doesn't understand business. So you got to respect him for that, at the very least. So, the spring's selling season will test the market, according to Lawless. Mr. Lawless said another key factor likely to constrain further price gains in the big capitals is the extra stock that generally comes onto the market at this time of year. As we move into spring, we do expect that there will be more stock flowing into the market, he said. We haven't seen many properties entering the marketplace over the past few years. My suspicion is that as conditions improve, and we see vendor confidence improving, we probably will see quite a surge of properties coming on the market. Mr. Lawless said he is not sure that there will be the extra buyer demand to match an increase in the number of sellers. Well, I mean, how could he be sure? How could he be sure? It's a market. Credit is still relatively tight, even though it has loosened up a little bit, that suggests we may not see buyer demand rising in line with supply levels together. Well, also the fact that, our job advertising is down too. We'll get the GDP figures in tomorrow. We'll see how it's going. AMP Capital Chief Economist Shane Oliver agrees that it is likely this price rebound will be limited to a rise of about 5% in Sydney and Melbourne over the next year or so. So if we go 5%, you can see here from the peak it's down 13%. So what is it? We're looking at up 5% of 87%. So there you go. So it's probably up 4% roughly from the, in peak money. Okay, cool. Rush out. Rush out. That's not a boom. Isn't that called a dead cat bounce? That's what a lot of people are saying. That's what a lot of people are saying. I mean, it's interesting once you look into the psychology of these markets and these things. It just flows all the way through. That's good coffee. Compared to past recovery cycles, household debt-to-income ratios are much higher. Bank lending standards are much tighter, such that a return to rapid growth in interest only and investor loans is most unlikely, he wrote in a response to CoreLogic data. The supply of units has surged, with more to come, and this has already pushed up Sydney's rental vacancy rate well above normal levels. And unemployment is likely to drift up as overall economic growth remains weak. While prospective first home buyers in the two big cities will be lamenting the return to price growth, Mr. Lawless said, at least they are not being faced with large rent increases. In Sydney, rents are generally falling and not rising by more than 3% elsewhere. Well, there you go. That's going to be tough for investors that are depending on that money to pay those huge mortgages. That's going to be tough. We're seeing an unprecedented surge in investment-grade apartment stock, he said. I think that's one of the reasons we're seeing some downward pressure on rents, particularly in Sydney. But also, we do see the fact that wages are hardly moving. It probably does suggest that renters are approaching a ceiling in what they can afford to pay as well. Oh yes, I know previous people have mentioned on comments how they got good discounts on rents. All these bonuses and things trying to get them to rent their apartments. I mean, now's the time, guys. Now is the time. So what do you think? Do we have a boom? Sydney, Melbourne, leading the way, leading the country to a boom. Everyone get in. Don't worry about fear of missing out. Don't worry about those emotional pressures. Go to that auction and bid, bid, bid. Can you tell I'm not entirely convinced? I'm not entirely convinced that there needs to be something else driving this. We had the population, we had a tremendous influx of foreign capital in 2016 that was driving up a lot of these new properties, a lot of apartments. You can see that in the data. What is pushing this up? Is it FOMO? Is it fear of missing out? What else is it? Is it the media? Is it low interest rates and people trying to jump in now while they can? Interest rates can go lower. They can go lower, guys. Seriously, there's talk about the RBA lowering rates again. So, no. I'm confused, as always. I don't understand. It just feels like people are just jumping to it. I don't know, guys. Discuss it in the comments. Let me know what you think. Do you think it's fear of missing out? Do you think I'm just too blind to see the coming boom and I need to sell everything and buy a beautiful, high-quality apartment with feature cracks in Sydney and Melbourne? Free flammable cladding thrown in the mix. Anyway, guys, like, share, and subscribe. Thanks for watching, and I'll see you next time. Bye for now.